This is a download from BFM 89.9, the business station.
Hi, good morning, Dodge. Now, before we look to the week ahead, I'd like to get your thoughts on last week's data on U.S. First quarter GDP that came out on Friday.
Good morning, Melissa. Well, it was negative 4-1. The Chicago factories faltered. It nearly hit February's six-year low of 45.8. That was a 6-point fall in May, back down to 46.2. That's in contraction territory. Corporate profits fell 5.9%, the biggest decline since 2008, and it was the first time profits fell for two straight quarters. The leading U.S. index, ECRI, fell 0.2 for the week ended May 22 to 133.7. It was the first drop in over 2 months, quite negative. And consumer sentiment, that also fell down from 95.9 down to 90.7. It was the biggest monthly decline. So it was quite negative overall. There was one positive, and that was in the pending home sales. They jumped to the best reading in 9 years, and it suggested that the late spring housing pickup has legs. And yes, we're seeing that in New York as well. So that is a positive, and I think it does bode well for a turn in the economic factors going forward. But right now, the history has been negative for the year.
Well, do you think it'll get worse before it gets better, Dodge?
I think that it's going to take more to get better, and I think it will have some impact on the perception of where the U.S. is, and there'll be more of a focus, Melissa, on the U.S. separate from the rest of the world as to how the U.S. is doing by itself. So, yes, I think it's going to take more to get out of this negative range, but we are going into a better part of the year for us. The expectations are more positive. So I do think that despite the greater effort that's going to take, I think we will achieve it, and we'll start to see much more concerted improvement as we get to the end of the third quarter.
Right, well, it is the start of a brand new month, June, and it looks like a very busy week ahead as well, with investors eyeing the May jobs report on Friday that should indicate the strength of the U.S. economy. What are your expectations for that data, Dodge, and do you think it could likely change market perceptions about when the Fed might start raising rates?
Well, yes, this is one area that I am positive. I think we're going to see around 230 to 240,000. The average is 235. We may not hit 235, but it makes our pipeline look quite positive and healthy as we go into the second half. We see the jobless rate falling from 5 to 5.3%, but Melissa, that I'm not impressed with that. Really, we need to see a higher jobless rate because that will imply more people looking for jobs, and then that in turn implies that there is a greater expectation of jobs. So I do think that we're going to see continued growth in jobs. What I'd like to see is a conversion of that factor into more people looking for jobs.
So any change on when the Fed might start raising rates? We have to ask that question.
Oh, yes. Well, I think the third quarter is more likely. I think by the end of the year, the probability is so high that there is going to be a change in market perception. If we do not start the rise in rates, then the perception of the market will be much more negative than it has been. I think the expectations are that the U.S. economy is strong enough to make the transition that we've been talking about for a long time now into higher interest rates. And if it doesn't happen, it's indicating that the Fed doesn't think we've improved as much as the market feels. And so the perception is going to be very, very important. I think June is come and gone. I don't think we're going to see an increase there. I think it's totally unlikely. But as we get to September, then the expectations are such that the expectations are quite high for September. And if it doesn't happen, then I think the question becomes more negative, and then the perception will turn negative in terms of the market reaction as we get to the end of the year if it hasn't happened. So, yes, we are getting to a shorter time frame for this to occur within the Federal Reserve expectations, and because that time frame is getting shorter, the reaction to it not happening will be much more serious.
Right. If we could quickly look across the pond, Dodge, now anxiety over Greece's debt crisis has been reignited this past weeks. No deal in sight for Greece yet. Are you expecting an impact on the bond market and the dollar-euro cross?
Well, you're right. I mean, it is looking much more negative. It looks bleaker now because Cyprus is now accusing the bailout monitors, the IMF, particularly the IMF and the European Commission and the ECB, but particularly the IMF, for not yielding in the face of significant Greek concessions. But we've seen this before in other global negotiations. You have to go through this period where it looks like it's not going to happen. And in fact, in the case of Greece, I suspect that there will not be an agreement, and the risk of a Greek exit will be much higher. But ultimately, the situation will turn around, and Greece will be able to stay within the Union and within the Eurodollar. But it's going to be a huge play, and it's going to happen after the midnight hour. So the market's reaction up to when it actually, I would say, up till the fourth week or so after next week, that's when I think we'll start to see some action that will be more positive. I do think the market is going to have to react as if it's not going to occur, because as part of the negotiations, Melissa, they have to, both sides are indicating that they're not going to fold, but they are beginning to come together. But the fact that Cyprus came out only days after his government claimed an agreement was imminent. This really increases a sense of chaos in the negotiations, makes the market's reaction to it much more negative for the short term.
But Dodge, I mean, there seems to be a lot more chatter about a Grexit. The IMF's Christine Lagarde said a Greek exit is a possibility. I think the U.S. Treasury also warned of a Grexident. Do you think the market's learning to accept this as a possible outcome?
Well, that's an interesting question, Melissa. No, I don't think the market has begun to accept the possibility. I think that the market reaction, if it actually is going to occur, where there is an exit, will be much more serious than what is being implied so far. The market is accepting the fact that there's going to be a lot of drama up until the point when there's a decision to either exit or not. And I think that the ultimate timing of that, the final decision, will be well after the market believes it can occur. That's just part of the negotiations, particularly when you're dealing with world negotiations. The fact that the U.S. has now stepped in and started to come in with an opinion, the fact that we're so far away from the actual negotiations, but we're beginning to indicate our concern. Yes, that is of concern, and the market will begin to reflect that. But in terms of the ultimate market move and the ultimate market reaction to whether Greece exits or not, we're far away from the ultimate reaction, and there's a lot more drama to go through before the real decision is going to have to be made.
Dodge, always a pleasure. That was Dodge O'Dolan, Chairman and Chief Investment Officer of Lender of Use Capital Managers in New York.
Thank you for listening to this podcast. To find more great interviews, go to bfm.my or find us on iTunes. BFM 89.9, the business station.